the provisioning numbers and the slippage numbers were higher than what we have had in prior quarters. If you look at the core operating margins, etc., though we have had a fairly healthy performance. Our operating profit margins at 3.41% are actually higher than what our last 8-quarter average is. So on an operating level, we are fairly satisfied with the performance that we have had. You're absolutely right on the asset quality level, though, and on the slippages side. As we look forward into the next few quarters, we continue to see the watch list that we had put out continue to slip through into NPAs. We had said in April that we are going to see a first half bias towards slippage from the watch list. That's playing out exactly as we had thought. So that story is going to continue a little bit, but outside of the watch list, things are looking fairly strong, and both from a risk environment perspective as well as a growth opportunity perspective. So we feel optimistic about what lies ahead, certainly on the operating front, and on the asset quality front, you'll have to look at the watch list and the rest of the world separately.
What was the quantum of slippages from the watch list this quarter?
This quarter we had about 2,900 crores of slippages overall from the corporate lending segment, and of that about 92% came from the watch list. So from our original watch list, which was some 22,600 crores or thereabouts, about 12% slipped into NPA in this quarter.
Which sectors do you think are still under stress, and if you could share your views on the infrastructure and metal sectors, the existing exposure that you have towards these sectors as of now?
Yeah. If you see our watch list, the top two sectors are clearly power and iron and steel. So these continue to be problematic sectors for us. In both of these sectors, actually, the situation has improved a little bit in the last few months. In the power side, because of some of the government interventions around the Uday scheme, etc., as well as what has happened on the coal side, with coal availability actually being a lot better than it was 6 or 9 months ago. So situation is getting a little bit better on that front. On the steel side, commodity prices have actually gone up in the last few months, and again, government interventions in terms of the minimum import prices has helped. Now, how long that sustains and whether it will continue to give enough benefit to these firms that they can actually repay their debt, well, that we need to see. However, situation has improved marginally for both of these sectors.
What about slippages from the retail and SME book? How did that pan out during the quarter? And this is, of course, outside the watch list. If you could share your commentary on that.
Yes, retail and SME both tend to have a little bit of a seasonal peak in Q1. Retail agriculture in particular tends to have a strong or high Q1 in terms of slippages, and then things tend to taper out as we go through the rest of the year. This year things are going exactly as per plan, so we are actually not perturbed about what the level of slippages that we had in retail, retail agri as well as SME. All of these we are happy with the risk performance that we are seeing, and they continue to be on a very steady footing.
Also, what was the value of loans that were restructured and rescheduled under 525 and SDR?
Yeah, we have some of the numbers, in our quarterly presentation. What I'll say is that from an overall quantum perspective, restructuring, of course, has come down pretty dramatically since the classification clarification on restructuring happened. So we had 2 accounts restructured in this quarter. Both of those were because of shift of date of commencement of commercial operations. So fundamentally, terms restructuring actually didn't happen at all in this quarter. If you look at SDRs, again, we had a couple of SDRs in the quarter, relatively small-sized ones, nothing very significant. One other thing that we did in this quarter is our entire SDR outstanding, on which RBI asks you to do a 15% provisioning staggered over 4 quarters. We went ahead and actually did the entire provisioning on our portfolio in 1 quarter. So that's one of the other impacts that you see in our provisioning number.
And any assets that were sold to ARCs during the quarter, and do you plan to sell any assets that you have on your books in the coming quarters?
No, we did not sell anything to ARCs in the last quarter. However, selling to ARCs is always part of the toolkit that you look at when you're looking at resolving accounts. So whether we will sell something to ARCs in the future or not, that we will see based on a case-to-case basis, how the economics of a specific case work out and what pricing one might get for it, etc. But that's certainly part of one's strategy toolkit, and we will use it wherever it's appropriate.
Also, if you could take us through what really panned out sector-wise. You did mention that power is one sector where you saw a lot of pain. Apart from certain accounts in this space have already been categorized as NPAs by many banks, could you share your views on the same? How do you see the response as far as these the repayments are concerned from many of these accounts?
Right. See, in power, a lot depends on how the entire value chain behaves, right? So you've got coal and mining on one side, and you've got power generation that's happening, and then you've got distribution, and you've got the distribution companies, and of course you've got the end consumer who's essentially paying, right? What we have seen is that the distribution companies, of course, which were the source of a lot of financial stress, and that stress was spreading throughout the value chain with things like the Uday scheme, etc. That stress has gone down pretty substantially. Now, when that will start benefiting the rest of the parts of the value chain, we'll have to wait and see. But certainly, the distribution side, the situation has gotten better because of some of the restructuring that has happened there through some of the government interventions. For this to sustain on an ongoing basis, we need to see more discipline across the entire value chain. We need to see discipline in terms of coal production and sustained policies there, and we need to see discipline in terms of pricing of power for end consumers. If that happens, the rest of the value chain will resolve itself.
Also, what is your outlook on loan growth and credit cost going forward?
We had a very good quarter in terms of loan growth. In Q1, we saw our advances book grow by 21%. Retail, on the core retail part, actually grew 26%. Our corporate book grew 21%, and SME grew 13%. So overall, we are happy with the growth that we have seen in this first quarter. We continue to see good opportunities in terms of advances growth, particularly as we are seeing some market share shift happening out in the marketplace. So our expectation for the full year is about 18 to 20% of advances growth.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.